right, hi you guys. It's by Alexis YouTube, and I am back again with Micah Greene. And I'm sorry, you guys, it's been like 3 weeks since I posted a video, but I am back. I'm making it up to you. I got some really good stuff for you, and actually, Micah is going to be doing most of the talking. He has all the questions. He is asking questions that come up the most. So I'm going to let him take it away.
So, hello everyone. Again, my name is Micah Greene with Homestar Financial. I'm going to jump right into it. Kind of this segment, we're going to call it Mythbusters. And what we're going to do is basically just kind of go over a few things that some people think they may know, but technically they might not know. So, I'll jump right into it. And the first one is, do I need 20% down payment? This comes up a lot. I know this is something that I actually thought about myself prior to purchasing, and actually prior to even getting into business. I thought you always needed 20% down. So yes, that is a myth. You could actually get a home with 0% down with USDA financing. You could get a home 100% financing with VA loan, or you could go conventional 3% or 5%, or FHA is 3.5%. So no, you do not need 20, 30, $40,000 to get into a home. That's a big key that a lot of people think they got to keep saving, keep saving, keep saving. They don't have enough, keep saving more. And so actually you don't need that much. So what you always want to do is get with a lender to go over products and programs to see what you're eligible for in regards um, your income first, and that will determine how much you can afford as far as the purchase price. And then you start getting your options from that point. Okay, so that's the first one. That's a big one. Actually, my second one is, do I need a 750 credit score? That is actually another myth that everybody thinks they got to have a high credit score. So no, you don't need a 750 credit score. Actually, a lot of people don't know, to be honest with you, you can actually get into a mortgage, a FHA or VA mortgage with a 500 credit score. So that's actually what those two entities require. And then the overlays come in with your actual lenders. So that's why you have maybe 580, 620, 640. So different lenders actually have their own overlays on top of the product overlays that comes with these programs. So right now, just say, for instance, Homestar overlay is for FHA and VA 620 credit score. So right now you can actually purchase a home with a 620 credit score. And again, that's just part of the requirement that you need to purchase a home, okay? To go along with that, do I need a perfect credit profile? And what I mean by that, can I have collections? Can I have charge-offs, things like that on my credit report? And the answer to that is yes. You can have what we call bruised or challenge or kind of some discrepancies on your credit report and still get approved for a mortgage. The good thing about that, you want to get with the lender again to kind of figure out how recent some of these collections are, how old are they, how much are they, because there is a 5% um, debt that we add to, or 5% payment that we had to each collection that's non-medical. Student loans, you get a 1% debt that's added to those student loan collections. So it's a lot that goes into it. And again, you don't have to have the credit profile, perfect credit profile to purchase, but you do have to show consistency in repaying back debt. And the way I always look at it, I always tell a lot of buyers to say, hey, if you was loaning your own money out to someone and the only thing you had to go on was their credit report, would you let somebody borrow 200, 300, or even $400,000? If they say no, that means they answered their own question. So why would somebody let you borrow that when they looked at your credit report when it's inconsistencies in regards to paying back debt? That's a big one. Another one that I know a lot of people ask, do I need to file my tax returns prior to purchasing? That answer is actually twofold. One would be, the first answer to that would be no, you don't have to file tax returns. So if you are a regular W-2 employee that receives just an hourly wage and no commission, no overtime, no things like that, you don't have to actually file your tax returns, which is a good thing. So, and not to say we care if you do or care if you don't, but in those situations you don't. So the times you really have to file tax returns is if you're definitely self-employed, you commission-based employee, want to see how much you earn, want to see how much you wrote off. things like that. But just a regular W-2 wage earner, you don't have to actually file tax returns, which is a crucial thing. So a lot of people will hold out until they file the tax returns thinking, hey, they needed to do that. In actuality, you don't. Um, Another big one for me is, do I have to work on my job for 2 years? The answer to that again is no, you do not have to work on your job. You just need a 2 year employment history. So you don't necessarily have to be at the same job, but what you want to do is be employed for 2 years or more. So, and again, that 2 years can cover maybe a year in college. Also, you could do it for a year in college. You could do 6 months in college. You reuse your transcripts actually to kind of fill in that gap as far as the 2 years. So yes, you could go to college, get out, start working, start receiving income, and apply for a mortgage at that point. And so you don't necessarily have the 2 year employment part, but you actually do have the school, which is the transcripts, and we can use that to kind of get you into your home. So that's kind of some big ones that I have. It may be some more that I know you guys hopefully will listen to this and ask some questions to Alexis and I, and hopefully get back with you and answer those questions.
So one question I do have is, I know the issue of secure credit cards came up, and I'm
Okay.
curious as to, is it better to go to like a credit union, or can like one of those one main financial cards do it? I mean, is there a difference?
It is. So secured credit cards, of course, is, a lot of people typically get them. They're a lot easier to get. You don't have to worry about credit checks, things like that. So I would suggest that, if you're working on credit, that would be, to me, your first option, where, you're not going to get turned down. Now, the second part of that is far as credit union. So you got to remember that 9 times out of 10, a credit union just don't report 2 or 3 bureaus. So when you start building and working on your credit, it's important to make sure any card that you get, that you're going to get, is going to report to all three credit bureaus, because that's going to be the key. Where you don't want, say, usually credit unions like, I don't know, Equifax or one of those, but they're only going to report to one bureau. And so at one bureau, you may have a higher score on that one bureau, but your other two scores, now that you got that particular card, is still at 580 or 570 or 580, where your other score that the credit bureau is using may be at 650, but the other scores is low. So I don't suggest getting a credit union secure card or a credit union credit card only unless it reports to a three. And this is in regards to establishing credit. So if your credit is fine, if you want to get one, that's perfect. But in regards to establishing credit, it's big to make sure you establish all three credit bureaus.
Sounds good. Awesome. Now, I think those were all the questions that I have. Are those the most common ones you get asked?
Yeah, the most important one is, of course, the credit score, right? So we always hear, hey, what's my minimum credit score? What else do it take? So again, the credit score one is always the biggest question. And I always tell everybody, it's not the score, okay? The score just gets you in the door, but you want to make sure you can get approved. So it's the credit profile that we just talked about that goes along with it. And with that profile, like we just talked about, you really want to make sure you establish yourself as somebody being worthy of not only just repaying debt back consistently, but you're able to accept new debt, right? So if you can't, and what I mean by that, what the underwriters look at is, if you consistently late on small items or anything like that, they're gonna just say no, we can't get you approved because you haven't shown us that you can repay back debt. So there's no need to give somebody more debt when they got a profile showing that they can't pay what they currently have. It doesn't make sense.
Right.
So that's what I always tell everybody to say, hey, put yourself in position to purchase. And with that being said, what you got to do is you got to be able to afford and pay your current debt before somebody would allow you to get more debt. That's just how that mortgage process goes. And again, it's totally different than renting, right? Renting, they don't care how much debt you have. They just want to know that you can afford 3 times the amount of rent, typically, right? They don't look at how much debt you have. They don't count it. They just say, hey, you make X amount, the rent is this, you're fine. No, in mortgage situations, we don't do that. So we're not going to put you in a situation where we know you already got $3,000 worth of debt. and you're already maxed out, let's say, as debt as far as debt to income, and we're gonna put you in a $300,000 home. Just because, hey, you make 3 times the amount of what the mortgage payment would be. That doesn't make sense. I tell anybody to say, don't get me wrong, you got to do what you got to do in regards to renting, but it doesn't make sense the way they go about renting, because again, that's one of the reasons why a lot of people fall behind because of rent. So yeah, they make sure they pay their rent on time, correct. But now with them doing that, they have no more money to pay their other debt.
Right. Right.
And that's the crucial key of, just being, more conscious of, um, hey, how much you can afford to pay for rent and your other bills. Not say, hey, well, no matter what, yes, no matter what, you got to have a place to stay, but no matter what, you got to make sure you can afford wherever you're staying at with your current bills.
Right, exactly. I know a lot of people don't look at it from the point of view of, um, if I was another person, would I loan me money? People don't look at it that way. People just think, oh, I want a house, and I'm going to go out here and I'm going to see if I can, get a loan. But from your credit score, your credit report, your debt to income ratio, no, nobody's going to loan you money. And it makes sense. It's logical. It makes sense when you think about it that way, when you put yourself in the shoes of the mortgage company.
Yes. Well, I had a conversation a lot, but I literally had a conversation with a young lady last week, and she just said, "Hey, what do I got to do to get approved?" She said, "I already know this, I know that," and I said, "Okay." And I said, "Well, scores are very low, no consistency of paying things on time." And I just had the hard conversation of telling her, well, you know what, if I looked at your credit, or you just looked at your own credit report and you didn't know who you were, would you let yourself borrow that type of money? And she was looking for $286,000. And she said, well, you know what, if I had to just base it off my credit report, I guess you're right, I wouldn't. And that's the simple way to tell people to say, hey, give yourself an opportunity to get approved or even get looked at, right? By paying your bills on time. That's the first step. I mean, you got to have several other things, but to give, and that's with anything like in life, right? You always got to put yourself in position to get somewhere, right? It doesn't happen typically overnight. So, preparing for a job, right? You got to, it might be some quote unquote prerequisites for that position. Maybe, a bachelor's degree, maybe some on a job training, but whatever it is, you got to prepare yourself. You just can't go in there and say, well, I think I can do this job, or I feel like I can do it, right? You want to give yourself some what we call some stabilizing factors to say, hey, will be a good representation and I'm qualified for this position. So with a mortgage, it's the same way. You got to put yourself in position to be qualified. And the way you do that is simple. Uh, and I wouldn't say simple, but it is simple because if you pay your bills on time, your scores will be indicative of that most of the time. And everything happens. So don't get me wrong, we're not bad people and say, hey, we kind of understand, bad things happen to good people. But we also understand that we're not going to, put ourselves or a company or put anybody in jeopardy of defaulting by knowingly giving somebody a mortgage. You see consistent patterns of them not paying their bills. So the default rate on something like that would be extremely high. Just like the default rate, believe it or not, is extremely high on down payment assistance programs. A lot of people don't realize. So don't get me wrong. And the reason why that's high and it's kind of risky is because what I do believe, and I've been doing this for a long time, where if you don't put no skin in the game, it's hard to walk away. It's easier to walk away, right? So if you bought yourself a $2,000 purse, you're gonna probably, make sure nobody touched that purse. You're not gonna sit it on the floor. You're not gonna do anything, right? But if somebody may have bought that for you, yeah, you're gonna still care for it, but not as if you put your hard-earned money into it. So that's one of the reasons why a lot of people typically walk away when they're in those down payment assistance program when life happens, so to speak. So when life happens and it hits, that person saying, well, you know what, I didn't put a lot into the game. I can count this as a loss, move forward, and maybe come back and revisit it again. Where you got somebody who put 5, 10, 15% down, even 20% down or more, they're going to be more likely to say, "Nah, I'm gonna fight for what I have because I put too much in it to lose at this point. So I'm gonna at least fight for it and try to keep it versus to walk away." So
Right.
that's why I'm just not a huge fan of down payment assistance because the numbers bear out that the high is just a higher default rate. So it's not so much of you know um, demographics. It's really the down payment system as a whole, and that's not even going into demographics. So the demographics is another topic, but just overall using that type of entry way to get your mortgage, like I said, as a whole, it's a higher default rate.
So there's no penalty for walking away. Let's say I'm over it and I just want to be done, but there's no penalty.
There's no penalty to you, but to you. Well, I take that back. There is a penalty, right? So you walk away. So it's two walking aways. It's one where, hey, I'm on time. I'm gonna just sell my property and get up from under it, right? Then there's another one, which is what is called foreclosure. So yes, foreclosure is a penalty to you, right? Where it's gonna kill your credit. So that I mean, so again, if you're just conscious of and literate kind of everything going on, you just typically the borrower who put a lot of money in, they're gonna do one or two things. They say, hey, before it gets overwhelming, probably sell, um, or if it does get overwhelming, they're gonna just keep it and fight whether they be late here or try to do this here or try to get a modification. They're going to do something probably versus the walk away. So where, like you said, typically if somebody doesn't have a lot into it, so if I go into a home with, if I got into my home, just say for instance, I put $1,000 out of my own money into it, I'm probably more likely if things get overwhelming, things get out of hand, to say, you know what, I'm done. If I
Right.
put $10,000 into it, and I'm not saying it's a lot, but it's way more than 1,000, I'm just more likely to say, well, I put $10,000 into it at this point. With equity, time I've been here now, this, that, and another, I'm just more likely to finally just stay. It's going to hurt me more to leave it at this point because I will lose more than I put in, right? So the numbers always bear that out.
Okay, so if somebody walked away, could they rejoin the program sometime down the road, or how does that work?
It depends. And what I mean walk away is want to make sure we specifically say what they did, right? So if it's a foreclosure situation, you're looking at about 4 years, 3 to 4 years with government programs. I would just say it like that. Longer with a conventional loan. So you got to, strategically say if you're going to walk away, you got to know, hey, if I walk away, how long this is going to take me. Um, because of course you got the foreclosure process, you got that whole process, you got the seasoning. So you actually got the foreclosure process, then you got the seasoning. So again, that seasoning is 3 to 4 years, depending on what type of financing that you're looking to do. And then you got to say again, you got to have, I wouldn't say you got to have a plan, but it'd be smart to have a plan because yeah, things come at you quickly. But if you own your home, if it gets overwhelming, you do need to speak to somebody
Right.
because you have options. Is you want to speak to maybe a lender and a realtor because you may be if you get just you may be able to sell your home before that. You still may be in foreclosure, but you can sell your home, get something back potentially. And again, that's only if, like I said, you're not cluttered with or up under these down payment assistance program where you got some equity into the home, right? So you got to have some equity to get something out. So that's why I said again, a lot of people who don't have that equity because of these down payment assistance programs, they just simply walk away because they can't get nothing out of the house, even if they sold it, because of these down payment assistance programs. They got to pay that money back to.
Right.
Yeah.
Okay, awesome. Good material, good information. So hopefully we'll be back next week with more answers. I'm pretty sure there's a lot of people out there who have questions.
Yeah.
Um, leave it below in the comments. We'll definitely, answer all the questions that we can. So once again, this is by Alexis YouTube. This right here is Micah Greene. So we will be back next week. Hopefully, if you guys have any questions, we'll be able to answer those. So subscribe, like, comment, all that good stuff. See ya.